It's a brand new week. Good morning, everyone. Welcome to this Monday Business. 55 minutes of current and relevant business talks. That's what we have to do at this time. I'm Ini John McQuan. We start as usual with what's going on in the global oil space. Prices fell today, raising last week's gains as loadings resumed at the key Russian export hub, where after that two-day suspension at the Black Sea port had been hit by a Ukrainian attack. And so we see for this morning deep down there because there's more supply now in the market. So we see 0.98% down for Brent. The price has gone down to $63.76 a barrel. For WTI, the price is more than 1% in the red at $59.43. Of course, we notice they're missing that $60 mark. Well, investors are trying to gauge how Ukraine's attack will affect Russia's crude exports in the long term, while also locking in profits after last week's rally. Overall, the perception of oversupply from OPEC Plus production increases still persists. And then here in Nigeria, we get to the NGX at the close of trade last week. So we did see the recovery in the middle of the week after the coordinating minister of the economy calmed nerves at the NGX on the floor of the trading floor, where he promised that there'll be a balanced capital gains tax. And since then, we saw renewed confidence from investors in the market. But I guess it was not enough to erase the total losses of the week. So at the end of the week, we saw that the market was in the red, 1.68%. Newly recovered 147,000 level was there. Equities cap of green, volume and value green, but the deals compared to the previous week was lower. That's why we see it in the red. For sectors, we saw a lot of recovery in all the sectors, from banking to consumer goods, industrial goods, and insurance. The only laggard is oil and gas, down 0.85%. But we see a lot of recovery happened around Dangote sugar, so that's why it's right there, industrial goods. Top gainers, last week, Guinness, Asso Savings and Champion Breweries, and top losers, Union, Daikin Salt, Austin Lars, and Multiverse Mining. Top trades were Cornerstone Insurance, Access Holdings, as well as Zenith Bank. Well, still talking around the market, Nairametrics has unveiled the maiden NMX 100 index, a first of its kind data-driven ranking of Nigeria's largest companies by revenue, offering the most transparent and comprehensive snapshot yet of the corporates powering Africa's biggest economy. Modeled after global benchmarks like the Fortune 500, the new index aims to reshape economic intelligence and close long-standing gaps in Nigeria's corporate data landscape. According to Nairametrics founder and Chief Executive Officer Ugodre Obichukwu, this is the plan for the future.
When we started tracking deals a few years ago, at that time, we're trying to figure out how much, because we noticed that when you have capital importation, like we all track, when NBS releases capital importation, the numbers most times don't tie with what we hear startups are raising. You hear Flutter will raise 100 million. You hear, when you check capital importation, you notice that there's a disconnect. So we realized, okay, capital importation tracks only the money that actually came into Nigeria. Now, let me give you context. Imagine maybe Flutterwave or Lemfi or any of these guys raised $20 million and they announced it. Now, what tends to happen is that $20 million will be paid into an account in the US, maybe their account in their US company or UK company. So it didn't come into Nigeria. But you know they spend that money in Nigeria, because what will happen is that they will now send that money to somebody else. That person will now give them the Naira equivalent in Nigeria. They will start spending. So one way or the other, that investment actually came in, but the CBN will not capture it. And so that's why sometimes we ask ourselves, people are hungry, no money, but there's more people are still spending money, because the mechanism for how we capture fund flows needs to change, because a lot of things are, a lot of the way this money flows is not the straightforward way.
Policymakers, academics, regulators, investors, and entrepreneurs have converged on the ASU Secretariat complex of Nnamdi Azikiwe University, Awka, for a high-level conference focused on repositioning Nigeria's economy through sustainable enterprise and deeper capital market participation. The event, organized by UNIZ Center for Capital Market Studies in partnership with the Securities and Exchange Commission, centers on harnessing capital market opportunities for SME growth and investment sustainability.
Policymakers, academics, regulators, investors, and entrepreneurs gather at the ASU Secretariat complex of Nnamdi Azikiwe University in Awka to brainstorm on ways to reposition the nation's economy through sustainable enterprise and capital market participation. The conference, organized by the UNIZ Center for Capital Market Studies in partnership with the Securities and Exchange Commission, draws from the theme Harnessing Capital Markets Opportunities for SME Growth and Investment Sustainability.
Globally, SMEs are the bedrock of economic growth, creating jobs, driving innovation, and promoting inclusive prosperity. Yet in Nigeria, access to sustainable finance remains a key challenge for SMEs. This conference seeks to address that gap by exploring how this capital market can become a catalyst for SME expansion, business innovation, and long-term economic sustainability.
Various contributors hammer the need to enhance financial literacy, deepen market participation, foster innovation, and promote economic growth, as well as market visibility for a successful capital market participation.
The most enduring benefit of capital market engagement is the institutionalization of sound corporate governance practices. When an SME embraces transparency, accountability, and structure, it secures its long-term future and unlocks sustainable investor interest.
In the lead paper presentations, the keynote speakers note that Nigeria has over 38 million small and medium enterprises, and 5 million of the enterprises are in the southeast, with about 30% in Anambra State.
We want to make the capital market work for the small business owners, not just the big corporates. There's also the ease of doing business, working with PEBEC, Corporate Affairs Commission, and Federal Inland Revenue, FIRS. We're making registrations simpler and cutting costs and helping informal businesses come into formal fold without losing their sanity.
The difference between the capital market and, say, a mutual market is not very much. The beauty about the capital market is that the buyers are enormous and they are unlimited. That is why it's interest and it's important you understand the way it works so that you can harness its power.
The expected impact of this conference includes improved access to finance for SMEs, increased investment in SMEs, and enhanced economic growth and development, as well as strengthened collaboration between academia, industry, and government.
The Financial Reporting Council of Nigeria has received the prestigious International Standards on Accounting and Reporting honors from the United Nations Conference on Trade and Development, UNCTAD, Intergovernmental Working Group of Experts on Accounting and Reporting. And Nigeria was the only African country that was honored by the global body. The feat is in recognition of Dr. Rabi Olowo's led council's exceptional leadership, they say, groundbreaking reforms and transformative contributions to to advancing sustainability reporting and corporate transparency in Nigeria. The award was presented to the Council during the ISA Honors celebration, which took place as part of the 42nd session of the Intergovernmental Working Group of Experts on International Standards of Accounting and Reporting in Geneva, Switzerland. And Nigeria there was awarded based on the FRC's leadership in developing a credible and globally aligned sustainability reporting framework, its multi-stakeholder engagement through the Adoption Readiness Working Group, and its successful implementation of national reforms that position sustainability disclosure as a central pillar of Nigeria's corporate governance and financial reporting. In addition, the award is a reflection of the impact of FRC in sustainability reporting landscape, not only in Nigeria but globally, with the Adoption Readiness Roadmap being a template for other countries. Now, Nigeria's Minister of Arts, Culture, Tourism and Creative Economy, Hannatu Musawa has been really busy. Last week, she was in Riyadh to attend the Tourist Summit, which ended at the end of last week. Well, I'm talking to her on part of why and some of the benefits of that meeting. Now, it's important to note that Tourist is a global platform shaping a new horizon for tourism. Ended after 3 days of meetings intended to catalyze investment portfolios totaling $113 billion. The inaugural summit has been viewed by players in the global tourism industry as a milestone that reflects Tourist's mission to unlock high-value deals by convening public and private sector leaders across tourism, technology, investment, and sustainability to set a shared roadmap for the next 50 years of global tourism. Conversations at the summit also covered the projection that travel and tourism will reach 30 billion trips and $16 trillion in global GDP by 2034. Nigeria intends to be an active part of this. And then this is one of the questions that we asked Nigeria's Minister of Arts, Culture, Tourism and the Creative Economy, Mrs. Hannatu Musawa.
Nigeria is trying to diversify. We're trying to grow our economy, and I think tourism for us is sort of a low-hanging fruit of where we can do that. And coming to Saudi at this very, very pivotal time is really a time for us to learn what Saudi is doing in terms of growing their economy using tourism. And really, essentially, I think what the Middle East has done is something that we can also borrow from. We have been working together with nations that are looking at Nigeria, the content and creativity, trying to use that and leverage on that to bring tourism and to build tourism in Nigeria. And for us, it's really about partnerships, collaboration, and using it as an inspiration. So, you know, being here at this pivotal time is something that I will go back home to use to really grow the tourism industry in Nigeria.
Then, well, Minister, we know that Dirty December is top on the federal government's list now. What are you bringing into Dirty December from Riyadh?
I mean, Dirty December is really the new oil, is the new you, is the future for us. You know, like I said, for us in Nigeria, one of the areas that people are most interested in is the content, the creativity, and the talent. Through our music, through our Nollywood, through our fashion, is really where we really flourish as a nation. So we want to use that as a convergence point to build and grow tourism. And Dirty December is really, that working in real time. Dirty December is when we use the whole month of December, from the 1st of December to the end of December, to really bring people into Nigeria that really want to experience Nigerian creative industry. So, you know, this is a project that we really want to see how we can sell and how we can promote using tour rise.
And we know that most of the sites are in the states. What's the collaboration plan between the federal and states?
So everything we're doing at the federal level is really working directly with the subnational governments. You know, tourism, Nigeria, it really has to look at domestic tourism as a key driver of economic growth. Every single state in Nigeria, and we have 36 states plus a capital, so 37 states, has a very unique peculiarity about it. And when you talk about tourism, everything is different in every single state. So rather than working at the federal level, we do handshakes with the state government so that the state government helps us to flesh out a framework for tourism. So it's the states that will really drive it. So everything has to do with handshakes so that we have one vehicle working and so that the federal government does not work in a silo with the state government.
And what would you say is the major takeaway from Tourist 2025?
I think my major takeaway, honestly, is the pace at which and the dedication and the commitment at which I've seen the countries that really are driving tourism as the future, the pace at which that they have committed themselves. Tourism is a huge value and a point of really creating that value in your different countries. And whenever I come to the Saudi Arabia and I see what they've done in tourism, and every time I come back, and I come here quite often, and I see the pace at which he has developed, is really something that I take back with me to Nigeria to really challenge ourselves as a federal government and just with the subnationals and just, you know, key players in the sector to see how we can drive ourselves to further push the envelope in ensuring that we open up all the different possibilities abound within the tourism sector.
All right, Minister, thank you so much for your time. And of course, we do hope that the takeaways from Tourist 2025 will be seen in the Nigerian economy. That was the Minister of Arts, Culture, Tourism, and the Creative Economy, Ms. Hannatu Musawa. Now, let's take a break on the program. When we come back, a lot of things in the front burner. For instance, we had that rating, a positive one, the first one from S&P in a decade. It was worth talking about. And of course, the suspension of the fuel import levy, that's still on a lot of people's minds, but that's after the break. Please stay with us. You're welcome back. It's still Business Morning right here on Channels Television. Now let's talk about that reversal by the federal government on the fuel imports levy, which of course has generated a lot of reactions as expected. So even when that was on, there were reactions to it. But I kind of weigh which one is heavier. Is it the reactions for or against? But we're going to delve into that with the Chief Executive Officer for Center for the Promotion of Private Enterprise. And just before he comes on, he did share a statement highlighting some of his thoughts on this. For instance, for CPPE, they believe that the 15% import duty was supposed to serve as an industrial protection instrument designed to support emerging private refineries, promote backward integration and industrial development, ensure a level playing field for domestic producers, conserve the scarce foreign exchange with the country struggling with, protect jobs, stimulate local value addition, reduce exposure to global supply instability, encourage long-term investments in refining and petrochemicals. And now that is being suspended or stopped, I don't know which one to use now, key concerns for CPPE include expensive energy and self-generation, that's for local refiners, high cost of capital, security-related risks, and risk to national energy independence, increased pressure on foreign exchange, loss of jobs, and industrial value chain. So now let's have Dr. Muda Yusuf share this in his own voice, some of his concerns about this suspension of the 15% fuel imports levy. Dr. Yusuf, good morning, and thank you for joining us on the program.
Good morning, Ine.
So I was just I was just trying to share part of your statements which you shared with us and with the public on this 15%, but maybe you should help us understand your perspective better.
Well, the major concern here is about protecting domestic industries. Currently, of course, Dangote refinery, is on the spotlight now. But the general principle of the position of CPPE is that Nigerian producers need to be protected. And already currently there are various degrees of protection for existing manufacturers across different sectors of the economy. Because the conditions in which they are operating is very, very challenging. And as a country, we need to make a choice. We need to make a decision. Whether we want producers or we should all migrate to importation. Of course, the latter is not a good option. And the government, of course, is committed to industrialization. If you are truly committed to industrialization, there has to be a framework to protect domestic industries. Already we have such protection with the pharmaceutical companies. We have protection for cement. We have protection for iron and steel. We have protection for many producers in the agro-allied industries. So it's not anything new. And for some of these protectionist policies, some of them have import duty plus tariff and import adjustment tax, sometimes up to 50%. Even in some extreme cases, close to 70% import charges. But here we are talking about 15% to safeguard emerging domestic refineries. We all know how much damage importation of petroleum products had done to this economy. It almost put this economy to bankruptcy. So we need to move away from that. So that is the whole essence of this argument. Of course, I heard people talk about increase in fuel price and all of that, monopoly and so on. Well, these are details that you can have conversation around. So basically, that is the concern.
You heard also the argument of perhaps these reforms need to be taken in bits. So if we add, we know that the tax reform is starting in a couple of months, then we add this to all of that, plus of course the one you have raised, which is what it would do to the price of petrol at the pump. Perhaps that is the consideration of the government. Let's take it in bits. Start with the reforms which starts in January and then see how that feels before we add another.
No, you see, Ini, if you have very comprehensive and robust conversation, this argument of risk of price increases of petroleum products, those arguments, it can be dealt with. If the governments work closely with those who have invested in the sector, you can come up with a framework on how to ensure that prices doesn't increase. There are fiscal policies, there are monetary policies, there are supports that you can give to domestic manufacturers to make sure that their prices come down. Because if you want to bring down prices, the solution is not to go and start importing. If you start importing as a solution, you will kill the manufacturing sector that is already existing.
But Dr. Yusuf, do you think that
the challenge?
Sorry, Dr. Yusuf, do you think that the government has had those conversations? First, remember when we talked about the subsidy removal, even the IMF and World Bank were like, the government should have put in place a social welfare structure before the removal. So these conversations you're talking about, are you aware that perhaps the government has had such conversations, or they want to take this time to have those conversations?
No, well, I'm not aware of any such conversation. But I know that that is the way to go. Because we have the interest of domestic investors to deal with. We have the interest of the consumers to deal with. Of course, sometimes these things can be conflicting. But if there is a very robust conversation, which I am not aware already exists, we can have policy regimes that we can activate or deploy, working with domestic producers to ensure that their prices are reasonable or comes down. It's not only for refined petroleum products. We can have similar conversation with those who are in flour mills, for instance, so that the price of bread can come down, the price of noodles can come down. We can have similar conversation with those who are producing cooking gas. That this is something that the common people consume a lot. How do we bring down the price? We will have solution, pragmatic, sustainable, and equitable solution. We can have it. We cannot say because of fears of price increases, then you now throw domestic investors to a complete loss. I mean, what kind of signal will it send to investors? That means we are not interested in production. Because there is no way a manufacturer in Nigeria, given all the challenges of production, can compete with products that are coming from outside the country that has no duty at all. Because these people are proposing, they don't want duty, no VAT. There's no manufacturer that can compete in that situation. And yet, in the interest of energy security, in the interest of job creation, I agree it's a delicate balancing act, but it's doable. Yeah, because we cannot afford to sacrifice a $20 billion investment by a Nigerian. I mean, that is unthinkable. So that is my own concern.
I guess another worrying factor in all of this is, maybe I missed it, and you can please correct me. We did not hear the reason that the government gave for ending this plan, and if there's a future to it or something.
Well, first of all, I read a report 2 days ago that the policy was only moved to first quarter of next year. That by first quarter of next year, this is the import duty will return. Perhaps there are concerns about capacity, domestic capacity. That okay, if you do this, if domestic capacity cannot cover up to 80 or 90%, and if you have imports coming heavily at that import duty, prices will go up. So the central concern, in my view, is about high prices. And I can relate with that. But my own position is that if you want to deal with the problem of high prices, the solution is not to go and open the doors for cheap imports to be coming in. The solution is to work with those who are on ground to come up with a framework that will not hurt them. Because we don't want those who have invested in production to regret investing in production. We don't want signaling. I mean, what kind of signal are we going to send to those who want to invest in the real sector of the economy? All of us cannot be investing in bonds and treasury bills, which is a comfort zone, as it were. We need people to invest in real economy, where jobs will be created, where there will be multiplier effect, where you can, ensure economic security. If so, a country like US is talking of protectionism, this is the biggest economy globally. Talk less of a country like Nigeria. So we need to balance these interests. And we need to worry about the kind of signaling it gives to those who are financing industries, to those who are potential investors. I mean, if you want to invest in refineries and you are seeing all of this, will you invest in refineries? Of course you will not. And if you have that situation, and then people will come and say there is monopoly, because we have scared people away. So I think engagement with manufacturers will go a long way in dealing with this situation.
All right, Dr. Yusuf, let's also talk about one development that happened towards the end of last week, and that's the S&P Global Ratings. They revised their outlook on Nigeria to positive from stable. And of course, this is good news. And I think the last time this happened, the first ever in over a decade, indicating a potential for ratings upgrade within the next 12 months if the government sustains its reform momentum. So this is kudos to the reforms that President Bola Tinubu has initiated and keeps driving. I guess this at least should give us a little bit of comfort.
Of course, of course. You know, these ratings have a way of projecting the economy as an economy where people can bring in their capital to. It improves the perception of the economy as a destination for investment. It lowers the risk of borrowing abroad. It encourages a lot of investors to come to different sectors of the economy. Sectors like the stock market will benefit because the perception that, okay, this is a stable economy, at least at macroeconomically is stable. It will encourage investors to come to the stock market. It will encourage investors to come into real estate, into infrastructure, into ICT. So the whole thing is about having a kind of, clean bill of health that, okay, this economy is healthy. You can go and invest there. It's not as risky as it used to be. If you go there, you'll be able to take your money out. And that is what the reform has done, because the reform had impacted on the critical macroeconomic variables. That is not generating this level of confidence. Before now, before the S&P rating, which was moved from stable to positive, we have had the Fitch. We had the Fitch rating in May. Sorry, on Moody's. We had Moody's rating in May. Before then, which was also positive. Before then, we had the Fitch rating, which was also positive. So all these ratings are very good for the economy. And I've heard people say, what is the implication of that for the average Nigerian? Is it going to put food on the table and all of that? The point is that if you have a rating regime that is positive for the economy, it encourages more investment into the economy. If you have more investment into the economy, it benefits everybody, including the common people. Because it is investment that will create the jobs. It will investment that will create the wealth. It will investment that will create revenue. So that is the nexus between these ratings and both the economy and even the welfare of the people.
Have this, Dr. Yusuf. What should we be doing as the people, as a country, as the government to maximize this positive rating or outlook that we have?
Well, what we should be doing is, because the major challenge we have had as far as the investment environment is concerned, we used to have macroeconomic challenges that has moderated significantly. The second major challenge that we normally have been having are the structural issues. We are talking about infrastructure, we are talking about consistency of regulation, we are talking about the regulatory environment. Those structural issues are very important for us to be able to optimize and harness and harvest the opportunities that these positive ratings could create for the economy. So we should address the structural issues. And on top of that, we need to address the issue of welfare, because it's a recurring decimal. When you report this kind of positive developments, people will ask you, will this put bread on the table? Will this reduce the cost of bread? Will it reduce the cost of noodles and so on? So that nexus we also need to develop. So we need to be intentional about ensuring that these benefits trickle down and put food on the table for the average Nigerian. So we play around with a lot of policy instruments and policy choices to be able to translate this into benefits both to investors and to the citizens. And you do that through the activation of all the policy instruments that are available to government. Fiscal policy, trade policy, tax policy, investment policy, forex policy, all these things. All of them can put something on the table to be able to address the concerns of the citizens and the concerns of businesses, especially the SMEs. So that is the way we can maximize or optimize these opportunities.
All right, Dr. Yusuf, I was just thinking, we talked a whole lot about having Africa rating companies and all, but I guess when we see positives like this, we don't remember that. But when we get the negative ratings, we think about having our own rating agencies. I haven't heard that conversation in a bit.
Yes, but you know, it is natural because the international or global rating agencies, investors globally reckon more with them because the target essentially is to ensure that we're able to attract more capital into the economy. Whether you are talking of FDI or you are talking about portfolio flows. That's not to diminish the importance of even the domestic capital. Even domestic capital. Some domestic investors will also raise money from abroad. So the significance, there's a huge differential in the value and the significance of these ratings. So I think it's normal for people to feel that, okay, these global ratings are likely to be more credible. This local ratings. I think that is the psychology, in my view, around that kind of reasoning.
All right, Dr. Muda Yusuf, thank you so much for taking time out, joining us in spite of, your attempt to be here and being held in traffic. Dr. Muda Yusuf is the Chief Executive Officer of
Thank you very much.
Center for the Promotion of Private Enterprise. Let's take a break now. When we come back, we'll go global. Please stay with us. That's right. It's time to go global, and that's with Laddie Williams, who's coming from the night journey.
Yeah, the night journey last week. Good to see you again, Ini, on this side.
During the day, Laddie.
Exactly, in the daytime. All right, let's get a check on what to expect for the global market this week. Investors are bracing for a defining week in November, this trading month. There's two major earning reports and a long overdue September jobs data that returns to the spotlight. With a record-breaking U.S. Government shutdown finally over, markets are now laser-focused on the economic fallout and how fresh data could shape sentiment heading into the final stretch of the year. So for Monday, we have the New York Fed Empire Manufacturing data. The index for November, with activity expected to ease to 6.7 from 10.7 points in the previous reading. A key snapshot of how factory conditions are holding up as year-end approaches. Then for Tuesday, markets are watching for a fresh wave of U.S. indicators this week, from the ADP weekly employment numbers to November's home builder sentiment, expected to hold steady at 37 points. Now we'll see October's import price index, industrial production figures will also be in focus, offering investors a clearer read on consumer demand in the U.S. and also inflation pressures and overall economic momentum heading into the year. And that's for Tuesday, the ADP weekly employment data. Then for Wednesday, investors are gearing up for a data-heavy session as NVIDIA, they headline this week's earnings, while MBA mortgage applications, October housing starts, and building permits offer fresh insight into momentum of the U.S. housing markets. That's what we have coming up for Wednesday. That's what investors will be looking at in the U.S. Then attention turns to the labor market as investors await the latest initial jobless claims and the restored September non-farm payrolls report, which previously came in at 22,000. So investors are looking out for that. So I guess we can expect a volatile market this week. We also have PMI right there in the U.S. So a lot of data investors will be looking at, and we'll see how that drives sentiment in most of the asset classes that we track. All right, let's see news for today. Japan's economy, that shrank less than expected in the third quarter of 2025. We see the GDP data showed today as steady capital spending among businesses. That helped offset weak private consumption. GDP fell by 1.8% year-on-year in the September quarter, less than expectations for a drop of about 2.5%. But growth turned negative from a 2.3% increase in the prior quarter, which was also revised higher. That's all we have for in Japan right there. Then to the automobile industry, Chinese automaker Geely Automobile on Monday reported a 59% increase in third quarter net profit as vehicle sales surged amid intense competition in the Chinese market. The Hangzhou-based company's net profit rose 3.82 billion yuan. That's about $538.1 million from 2.4 billion yuan in the same period last year. Then we see Alibaba, they've launched the Quen app in a public beta. That's the group launched the public beta of its new Quen app. That was today, marking its strongest push yet into the consumer artificial intelligence market. The app is powered by the company's latest Quen 3 model and is intended to bring its AI capabilities directly to everyday users. The Quen app is now available for free in China on iOS, Android, and web and PC platforms. It will serve as the main consumer interface for the company's flagship Quen series of models. That's right there for Alibaba. Then exports to the United States from India sank by 12% in September on an annualized basis, reflecting a spike in U.S. tariffs on goods sent out of a South Asian country, according to research from the Bank of American Securities. President Donald Trump placed additional levies on India's exported items earlier this year as part of a bid to put pressure on New Delhi over its purchases of Russian oil. See, that's still in the news there. Then to some big investor moves. Billionaire Peter Thiel exited his entire stake in artificial intelligence major NVIDIA. Filings showed over the weekend amid growing concerns over an AI-fueled bubble in technology valuations. Thiel sold some 537,000 shares in NVIDIA Corporation through the July-September period with a Form 13F filing from his Thiel macro fund showing that he no longer held any shares in NVIDIA as of September 30th. And it's quite interesting. We're looking out for their earnings later this week. We'll see if there's an impact there. Then we'll see Morgan Stanley. They've downgraded several major tech hardware giants, including Dell, HP Inc., and Hewlett-Packard Enterprise, as soaring memory costs and fading non-AI hardware demand. That squeezed margins across the sector. The bank warns that the industry is now deep in a memory supercycle with NAND and DRAM prices surging as such as 300% in 6 months, a trend analysts say could pressure earnings well into 2026. Then for Bitcoin, we see the price slip below $94,000, hovering near a 6-month low as hopes for a Federal Reserve's rate cut. That's fading. Markets have trimmed expectations of easing in December amid a resilient U.S. labor market and delayed economic data releases. So definitely a lot to look out this week, and we'll give you more updates on what's playing out with most of the markets that we track. That's on Business Incorporated. So that's basically what's happening right there in the global space today.
All right, Ladi, thanks for taking us around the world there. Yep. I must say this week is a very special week. It's the week after, I think, about 48 weeks of government shutdown in the U.S. So while that has happened, I believe that was on Wednesday, it's too soon to expect that things have become stable in the United States with the dollar and all of that, even though sentiments are positive. But I mean, we can expect that before normalcy will begin, or what we'll looking forward to a normal state, it should take some time. Yeah,
it should take some time because a lot of data that was expected in previous months, that might not come out again. So there's a lot of missed data in the U.S. right now, and definitely we know how data impacts investor sentiment in the U.S. So now the question is, what do we do with the missed data? We just forget it. Some of that data that was supposed to come out before now, and now look to the data that are supposed to, come out next. Guide, sentiments about the economy in the U.S. and, investors. So it's a very delicate balance, right now.
It's an interesting week. I think it's not something that we see often because you have the data, and then you have, of course, the government spending, a lot of which have been suspended, especially the ones for welfare, the traffic, the air traffic, the airport.
Yeah, aviation was in turmoil in the U.S.
It'll be interesting. Maybe one of these days we'll get correspondent to Washington, Mara Bird, to tell us how they're settling in. Are they going to, for instance, at the airport, are they just going to open at once? Or will it have to be gradual?
Maybe a phased opening.
Exactly. And then you also had the employees who have been away from work since, and the threats not getting paid, getting fired, and all of that. Which one are we seeing at this time? I guess these are very interesting developments.
I also saw, over the weekend, I think President Trump also handed out some $10,000 each. That's a lot of money. I wonder where that fund is going to come out from. At this point, and there's also that talk about, is it going to get to all the workers? At this point, 10,000, that's a lot of money.
I know, I know, right? But that also comes back to our own here in Nigeria when the labor union goes on strike and the federal government threatens no work, no pay. So we'll see the lessons that we can learn from all of that. Exactly. All right, Laddie, thank you so much.
Thank you.
Yeah, and see you at 1:30, yeah?
Yeah, I'll be back at 1:30.
All right, so Laddie will be here at 1:30 to give us especially what's going on in the market. Unfortunately, I have a red news for you. In early trade, Nigeria's stock market has lost 0.10%. We lost the 147,000 level, which we closed with on Friday. That's really unfortunate. But we're still looking close. We're at 146,964.55 early trade. So hopefully Laddie will go and do some magic behind the scene, and we will see the green color when it comes at 1:30 for Business Incorporated. But that's it on Business Morning. Thank you so much for being a part of it. It's a fresh week and we have a whole lot ahead of us, and we hope to have you there joining us at every point in time. I'm Ini John Mekwandu. Have a great and profitable day. Bye-bye.